You've probably seen the headlines. The investing legend, Warren Buffett, is selling even more stocks, sitting on a record cash pile. On the surface, it's easy to assume Buffett is potentially bracing for a crash, going all in on cash, and waiting for the markets to tumble. To make matters worse, in a surprising twist, the same Warren Buffett, who has always told us that the best thing most investors can do is to buy the S&P 500 and hold it forever. Now, he's actually dumping it. Naturally, this news sent a lot of investors into a frenzy. Some investors are wondering, should I also sell my index funds? Before we hit the panic button, let's break this down. So here's the deal. Berkshire Hathaway actually sold 100% of its holdings in two S&P 500 ETF, the SPY and the VOO. Sounds scary, right? But let's add some perspective. They sold roughly 39,000 shares of SPY and 43,000 shares of VOO. Assuming that he sold them at the end of the last quarter, the holdings will be worth roughly about $46 million in total. Now, don't get me wrong, that's a lot of money, at least for us. But for Berkshire, that's a rounding error. We are talking about a company that actually manages nearly $270 billion in stock, and that's excluding the $325 billion in cash that they're parking in the treasury bills right now. So this S&P 500 sale actually made up less than 0.01% of the entire portfolio. And that's like someone with a $100,000 pot selling off a $7 position. Seriously, it's not even worth your energy to track that position. In fact, Buffett and his team never made a big deal about owning some of these ETFs in the first place. So it's likely that they ended up in the Berkshire portfolio as part of a temporary cash investment or from an acquisition. Selling them wasn't some grand statement. It was probably just some housekeeping. And here's what that matters. Smashing the like button, of course, so don't forget about it. And here's what actually matters. Buffett isn't just selling ETFs. He's been a net seller of stocks for the past 2 years. And Berkshire is now sitting on a massive $325 billion cash pile. Historically, when Buffett builds up this much amount of cash, it's not because he's bearish, but it's because he's waiting for an opportunity to strike. So he did this right around the 2008 financial crisis as well, as seen from this graph from capital.com. But Buffett is a mere mortal too, and he did not manage to catch the absolute bottom of the bear market, but instead started to deploy his capital whenever he spots opportunities. In fact, in the latest disclosure, he's also confirmed that Berkshire has not bought back its own shares since May of last year, which would be an indication that Buffett probably don't see his stock as cheap. However, in his annual letter to shareholders, he has categorically assured investors that despite the rising cash pile, Berkshire remains firmly committed to equities. So he made it clear that while their holdings in publicly traded stocks declined from 354 to 272 billion, the value of their privately owned businesses actually increased, and still it outweighs the marketable portfolio. So this reinforces a key principle. Berkshire is not pivoting to cash as a long-term strategy. In his own words, Berkshire will never prefer cash over owning great businesses. And while the company has been selective with its recent purchases, including holding off on the buybacks, it doesn't mean Buffett is sitting out. And he's waiting, not retreating. So the key takeaway here is that Warren Buffett's portfolio moves should not dictate your own personal investing decisions, especially not in a piecemeal fashion. If you've built an investment plan based on sound principles, whether that includes dollar cost averaging into index funds, for example, or maintaining a diversified portfolio, or even just long-term buy and hold strategies, just stick to it. So Buffett's decision clearly wasn't about doubting the S&P 500's long-term viability. It was a reflection of Berkshire's unique capital allocation needs. So index funds were never a significant part of their portfolio to begin with. So their removal shouldn't influence how you manage your own personal investment portfolio. So here's the question. If you're not here to copy Buffett's every move, what can we learn from him? Well, actually there's a lot. In his latest shareholder letter, like all the others before, it's always packed with insights that investors at any level can apply. So the first lesson that came hitting hard was that mistakes are inevitable, but inaction is inexcusable. Buffett is one of the greatest investors of all time, but even he doesn't get it right all the time. Over the past 5 years alone, he's mentioned the words mistakes or errors 16 times in his letters. That's more humility than you can find in most Fortune 500 reports combined. So his longtime partner, Charlie Munger, had a no-nonsense approach to failure. He called it thumb sucking. So when you spot a mistake, you don't sit around hoping it fixes itself. You correct it. And the lesson, don't be afraid to course correct, whether it's cutting a bad investment, rebalancing a portfolio, or even refining your overall strategy. Next, he focuses on competence, and competence beats credentials any time of the day. So one of the more surprising statements in this year's letter was Buffett's admission that he never looked at where a CEO went to school, ever. So business talent, he says, is much more an innate ability than a fancy diploma. And that applies to investors too. So you don't need an MBA, CFA, or a Wall Street job to succeed. You need discipline, patience, and willingness to learn. Another golden rule, don't just focus on cheap stocks. So Buffett learned this the hard way when he bought Berkshire Hathaway itself. It was a struggling textile business that seemed like a bargain, but was in reality a sinking ship. And his main takeaway, a bad business doesn't become a good investment just because the price is low or just because it's cheap. Always focus on value, not just the price. So speaking of value, Buffett actually reminds us that great businesses rarely goes on sale, but when they do, you need to be ready. Berkshire doesn't jump in and out of stocks based on short-term trends. Most of the time, they sit patiently waiting for the right moment. But when those rare opportunities actually do come, when amazing businesses are available at a big discount, they actually go in big. And it's a lesson in patience and preparation. You don't have to swing at every pitch, but when the right one comes, you better be holding the bat. And for those of you who think that Buffett is just like any other investor, don't forget, he actually runs an empire of businesses. And running an insurance business actually requires much more than collecting premiums. So insurance is one of Berkshire's cornerstone, and Buffett reminds us that discipline in underwriting is critical. And if the odds don't make sense, walk away. It's a lesson that applies to investing too. If the numbers don't work out, no matter how tempting the story and opportunity might sound like, you have to be willing to say no. Finally, incentives matter more than you think. Berkshire doesn't use stock options or short-term bonuses. Their managers actually own shares outright, which means that they feel the pain of losses just as much as they enjoy the upside. So this alignment actually leads to long-term thinking. And as investors, we should take the same approach. So treat our portfolio as if we are business owners, not just stock traders chasing different price movements. And Buffett's letter isn't just about Berkshire. It's a blueprint for investing success. So don't just follow his trades, but follow his principle. This is CK from Piranha Profit signing off. Till next time, keep winning.